Facing a tax audit can be intimidating. The word audit might bring a sense of dread, but understanding what to expect can turn this daunting prospect into a manageable part of doing business. Let's demystify the process and prepare you to handle a tax audit with confidence.
Tax audit is an exercise carried out by Federal Inland Revenue Service to ascertain the accuracy and correctness of the tax already filed with them. Or, in another way, it may arise as a result of maybe a referral from intelligence unit, or it may be as a result of a routine from their normal exercise. So tax audit is related to previous tax returns somebody has filed. Specifically, it always ranges between 2 to 6 years. So the revenue is mandated to look at the extent of the compliance of various taxpayers, be it state or federal Inland Revenue Service.
An audit doesn't always mean something is wrong. It's a standard procedure to verify that your tax filings are accurate. Here is what you need to know to effectively navigate this process. There are generally two types of audits: desk audits and field audits.
What we mean by desk review is that when you file your annual returns, your audited account and your tax computation and capital allowances will be filed. So nowadays, you file it through the tax promise. Then you give a copy to them. Then we have some officers at the RPP, that is Risk Providing Unit. They will now look at the figures line by line. For instance, now, you can just say you have acquired additional official asset, plant and machinery, 50 million, furniture and fittings, 10 million, other vehicles, 100 million, furniture and fittings, 1 million. They will now look. We want to see evidence that these assets were acquired in the name of the company. You give them the receipt. And the law says that before you acquire any asset, you need to inform Federal Ministry of Industry. And the certificate are going to give you called certificate of acceptance. In most cases, the revenue will request for the certificate of acceptance to support that another party has physically inspected those assets and they were possessed in the names of the company. Because we have some people, they will possess assets, they can put the name of the MD there, they can put the name of the financial director there, but the revenue want to show that this asset was actually incurred in the name of the company. So based on that one, the revenue people, they will look at it. If they are satisfied, they will grant the capital allowances. If they are not satisfied, they will disallow the capital allowances you have claimed. For instance, now you have interest on overdraft. They will ask you, okay, you have interest on overdraft, X amount. They want to know the basis of arriving at that one. Give us the loan agreement as to the rate to be charged at the amount of the loan, whether it is properly disclosed in the account, because at times now, whether the interest is having even agreement at all. Because we have some people, you can't just say they have loan, but the loan may not be feasible. But they want to see third-party document to support that figure. So, like the employees' payroll, they will ask you, give us the payroll of the staff. Evidence of pay as you want. So, they will ask you, if you don't have evidence that you have remitted the taxes deducted at sort to FRS, they will disallow that amount. Then, like other expenses again, you have professional fees. They want to establish whether you have deducted withholding tax and paid the withholding tax to the relevant tax authority, be it state or federal. So they will ask that one. Then it may be other expenses that you have incurred. They want to know whether that particular amount is actually incurred, because there are 4 things you must satisfy in taxes. The amount you are incurring to earn an income must be reasonably, exclusively, reasonably and necessarily incurred in the generation of those income. So if the expenses were not incurred to earn that income, they will disallow it. So that is the end of the desk review, and they want to see your calculation. For instance, now you may use 50% initial, 25% annual for all your assets, whereas we have different rates. Plant and machinery is 50 in the year of purchase, 25% annually. Whereas furniture and fittings is 25% the year of purchase, 20% for subsequent years. Buildings and land and buildings is 15% initial, 10% annual. So they want to see the accuracy and correctness of the figures you are putting in the account. They want to see whether the account you have prepared, the tax you have prepared, is in line with the audited account you have submitted. Because at times they pass some adjustment. They just say, look, we want to see the adjustment you have passed to arrive at this particular figure. Then they will look at what you describe as your income. While all of them disclose, if they were all disclosed, were they adequately put on VAT returns on monthly basis? Is the aggregate of your monthly VAT returns equal to your turnover? So those are the things they will do at desk review. That is, the schedule officer will be checking item by item to ascertain the correctness or otherwise of the figures on the tax computation.
Tax audits are done at the tax office and typically focus on minor discrepancies or specific items in your returns. Field audits, however, are more comprehensive, with tax officers visiting your business to review a broader scope of records. First, preparation is key. Before the audit, you receive a notice from the Federal Inland Revenue Service specifying the date, scope, and type of audit. Use this time to gather all necessary documents such as receipts, invoices, tax returns, and any other relevant financial records. Second, know your rights and responsibilities. You have the right to understand why you're being audited, to be represented by an accountant or tax advisor, or to ask for a postponement if you need more time to prepare. You are also responsible for providing accurate information and cooperating with the auditors.
The process of tax audit is from two ends. From the point of view of the Federal Inland Revenue Service or State Internal Revenue Service, it's therefore identify the companies they want to visit within a particular period. Then they will do what we call a risk profiling. That is, they want to see whether this company has carried out its returns effectively. But before they can come to tax audit, for example, let us specify specific on Federal Inland Revenue Service. They must have carried out a desk review or monitoring exercise. So if they have not done desk review, it's always maybe very, very difficult to go for tax audit, because the government must have been on yearly basis. When you submit your returns, you file it, then they will look at the accuracy and correctness of the figures. They will ask for some document. Those people, they won't go to, those people in desk review, we call them RPP, they will not go to the company's premises. They will do it in their office. They will now raise queries, we answer it, we resolve it. Subsequent to that, because when the self-assessment commence, the policy is that every 3 years, each of the company must be visited for a tax audit. So those people, they will leave the office, they will now go to the taxpayer's office. What they normally do is that after their risk profiling, they will now inform the taxpayers that they are coming at a specified date. That date, they can give them about 2 or 3 weeks or a month notice, depending on their timetable from various tax offices. So they will fix a date. The company will now say, look, we are visiting your office for this period to this period. Gather all the necessary documentation that we enable to. They will now list all the items to be given to the tax auditors. So those items, they are inexhaustive. General ledger, bank statement, debtors ledgers, and stock. Mention any aspect of the company's transactions, you have to visit it. Then they will now come. At times, they may ask taxpayer or his tax consultant to come to their office for a pre-audit meeting. But in most cases, they will do the pre-audit meeting at the client's office. The first day they go there, they just say, where is your tax consultant? Where are the directors of the company? Who in the finance department? So they will familiarize themselves with the operation of the company. They will hold the meetings. They will know about the background information about the company, what they are to do, how many divisions they have, how do they, which type of account package they are using. So they will have the meeting. After the meeting, They will now say, look, we are giving you our requirements. Bring all those requirements for us now. You start from the general ledger, from the trial balance, audited account, management account, schedules that support it. So they may spend about 2 or 3 weeks on the field. But nowadays, they have limited the number of days they are now spending on the field because they have the habit now of collecting the information and go to the office to go and look at it. After they have collected all the information, they will do what we call exit meeting. That exit meeting is to inform the company the extent of work they have done, the outstanding document that they are supposed to give to them, which they have not been given. Either they want to make photocopy or they want to collect bank statement. So they will list all the outstanding documents which they've not been given. Then they will confirm the one they have given. They will pack their books and everything. They go to their office. Thereafter, they will write their letter on the, they call it audit findings. So whatever they have discovered, or maybe what they still need again, they put in their letter. That letter, they will ask the taxpayers or his consultant to provide them with the following document. So after they have reviewed it again, they will now call for what we call reconciliation meeting, whereby they will now tell the position of the revenue as to the treatment of some of the items. Probably they may, for instance now, they may have maybe some income that is not vatable. They will give us the document. They may have some assets which have acquired. They want to know the ownership of the asset. Give us certificate of acceptance. Like management fees, they give us your notable approval. That's okay. This expense is supposed to be earned by you. So you have no facilities. Give us the loan agreement from the bank. So they will now look at it. At the end of the day, they will now conclude the audit after the consultation meeting. They may go for about either 2 or 3 reconciliation meetings, but in most cases, it ranges between maximum of 2, because this assignment have lifespan based on the revenue's decision that no audit should be extended for more than 6 weeks. The date of commencement to the date they finalize should not be more than 6 weeks. They will now give you what we call letter of intent. The letter of intent will summarize the amount of tax you are going to pay. So if you agree, you will pay. If you don't agree, you object to the figure they arrive at. But whatever they arrive at is liable to interest and penalties, beginning from the period to the end of the audit period. They will still charge it because the tax performance now, immediately you put it on the tax performance to generate the payment reference number, we calculate the interest and penalty automatically. So that's about tax audit.
Third, presentation matters. Organize your documents neatly and logically. An orderly presentation can make the process smoother and help establish your credibility. Be professional and courteous with the auditors. Their job is to ensure compliance and they appreciate straightforward, respectful interactions. Fourth, understand the outcome. At the end of the audit, you receive a report detailing discrepancies or issues found. If there are no problems, the audit will close without action. If issues are identified, you might need to pay additional taxes, penalties, or interest. If you disagree with the findings, you can file an objection and, if necessary, an appeal. Going through an audit can be stressful, but preparation and understanding can alleviate much of the anxiety. Stay informed about your financial statements throughout the year. Maintain good record-keeping practices and consult professionals if you are unsure. This proactive approach not only prepares you for an audit, but is also good business practice. Remember, an audit is not the end of the world. It's a chance to validate your compliance and ensure your business stands on firm ground. Stay prepared, stay informed, and you will navigate through with confidence.